If you've blown multiple trading accounts, there's a good chance it wasn't because your entries were bad. It was because you were playing a game whose rules you didn't understand.
Look at this chart. Watch these clean, equal highs on Euro USD. Retail traders see a textbook breakout and place buy orders. Institutions see liquidity. Price pierces those highs, triggers thousands of buy stops, and immediately reverses in a massive displacement candle. That 15-minute move explains why so many breakout traders lose money, despite being technically correct. Now, think about that pit in your stomach at 2 a.m., desperately bargaining with the chart, hoping a drawdown reverses before it hits your rent money. You aren't failing because you lack indicators. You're failing because your trading pattern's designed to feed institutional order flow. Today, I'm breaking down the 3-pillar blueprint consistent traders use to align with institutional volume. Pay attention, because having a great entry while ignoring pillar number 2 is how most traders stay trapped in drawdown forever.
How many times have you taken a trade simply because you were bored on a Tuesday afternoon? You cycle through 20 pairs, force an entry, and watch price instantly chop sideways or hit your stop. Professional operators don't hunt for trades. They wait for high-probability liquidity sweeps during specific volatility windows. Pillar number 1 is restricting execution exclusively to session open overlaps. London Open from 2 a.m. to 5 a.m. Eastern Time. New York Open from 8 a.m. to 11 a.m. Eastern Time. Instead of buying mid-range, you wait for price to run key structural levels: equal highs, equal lows, the Asian range high, or the previous day's low. Notice this long upper wick poking above the Asian high? That's the stop hunt. The strong engulfing candle right after? That's displacement, where institutions reveal their hand. When you wait for liquidity to clear during these windows, most low-quality trades disappear from your journal. But entering at the right time won't save your account if your position sizing is broken. Which brings us to pillar number 2. Consider this contrast. One trader wins 8 trades in a row, gets overconfident, oversizes the 9th trade, and wipes out their entire account balance in 20 minutes. Another trader loses 6 out of 10 trades, but finishes the month up 8% because their risk math never changes. The setup isn't what destroys accounts. Position sizing is. Pillar number 2 is replacing emotional panic with an institutional risk architecture. Professional desks don't care about being right on every trade. They manage risk like a strict probability matrix. First, hard cap your exposure to a maximum of 0.5% or 1% per trade. Second, never take an entry unless structure offers a minimum 1-to-2 or 1-to-3 risk-to-reward ratio. When winning 3 trades completely covers 6 losses, a red trade stops feeling like a personal failure or a threat to your monthly bills. Execution becomes mechanical, and drawdown loses its emotional power. Yet, even with proper timing and bulletproof risk, traders still manage to sabotage themselves at the finish line. That's why pillar number 3 fixes how you execute on live charts. You don't fail because you don't know where price is going. You fail because you lack the discipline to do nothing when the market gives you garbage. Pillar number 3 is replacing live chart improvisation with a cold execution protocol. Before clicking buy or sell, your setup must check 4 objective boxes. Number 1, volatility window. Is London or New York Open active? Number 2, liquidity sweep. Did price take out a key daily or session high or low? Number 3, capped risk. Is risk locked at 1% or lower? Number 4, asymmetric payoff. Is there clear room for a 1-to-2 risk-reward target? If a trade meets 3 out of 4 criteria, you skip it. No exceptions. By writing down your triggers before opening MT5, every decision becomes a simple binary choice: yes or no. You eliminate impulse trades, FOMO entries, and post-loss regret. You stop reacting like a gambler and start operating like a business. And that brings us to the final hurdle, the silent account killer that catches traders right when they start seeing progress. Many traders string together 3 or 4 profitable weeks, feel invincible, and double their lot size on trade 5 to speed up their growth. Then they take one statistically normal loss, and it wipes out 2 full weeks of progress in a single afternoon. That is scale-up sabotage. Real consistency isn't built in one explosive week. It's built across hundreds of mechanical trades, executed with 0 deviation. Notice how these 3 pillars lock together. Market selection finds institutional opportunity. Risk architecture protects your capital. Execution protocols keep your decisions consistent. The edge isn't in any single pillar. Remove one, and the entire system breaks. Now that you understand the complete framework, the next question is obvious. How do you spot these liquidity sweeps before everyone else? That's exactly what we're mapping out step by step in this video right here. Click it, and let's go over trade setups together.
Now that you understand the complete framework, the next question is, how do you spot these liquidity sweeps before everyone else? That's exactly what we're mapping out step by step, and let's go over trade setups together.